Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. So today we're really getting into the weeds on Atlassian Corporation. That's ticker TEAM. We'll be looking closely at their Q1 results for fiscal year 2026. Operational performance, financials, the whole picture.
That's right. And Atlassian, well, they're fascinating because they sit right at this nexus, cloud maturity, the absolute explosion in AI, and just that constant enterprise need to keep things coordinated.
Exactly. So if you're trying to understand how a major software player is handling these huge shifts, this conversation is really for you. They aren't just reacting, they seem to be using these trends to actually accelerate.
It's a really compelling story based on the materials we've reviewed. Their Q1 performance really highlights how they're pushing forward on, well, three big fronts all at once.
Which are
Completing that cloud transition, really digging deeper into the enterprise market, and, crucially, weaving AI right into the core of their platform, not just as a feature, but as, like, the engine for what they call the system of work.
Okay, let's start with the numbers then. Ground ourselves in the data. It looks like a really strong kickoff to their fiscal year.
Definitely. Total revenue grew 21% year over year,
Yeah.
came in at $1.4 billion. It's a solid number.
Very respectable. But you mentioned the structure of that growth is key. What stands out there?
Well, the cloud business health is just paramount, isn't it?
Right.
Cloud revenue jumped 26% year over year. It hit $998 million.
Wow, nearly $1 billion quarterly just from cloud.
Almost there. But, if you want to gauge management's confidence and see what customers are really committing to long term, you have to look at RPO, remaining performance obligations.
Right, the RPO, that figure represents future contracted revenue. And yeah, that number definitely jumped off the page when I looked at it.
Jumped is maybe an understatement. It soared.
Mm-hmm.
RPO accelerated massively, growing 42% year over year to $3.3 billion.
42%. Okay.
Yeah, and that kind of acceleration, it tells you something important. It's not just small expansions. It suggests large enterprises are signing bigger, multi-year deals tied specifically to that cloud platform. It really validates the whole strategy shift.
And the scale they operate at gives that RPO number even more weight, doesn't it?
Absolutely. We're talking over 300,000 customers globally.
Mm-hmm.
This isn't some niche thing.
Right. Major names, too.
Exactly. Companies like Databricks, Expedia, Ford, Wells Fargo, they rely on this stuff for critical processes. Software development, yeah, but also customer service, IT management.
So when these big players sign multi-year cloud deals reflected in that RPO, it shows deep reliance.
Precisely. It underscores that they have this huge, valuable customer base that genuinely needs these sophisticated tools to handle complexity, especially now.
And that complexity, as you hinted, is just getting amplified by the biggest thing in tech right now, AI.
Which leads us right into their strategy.
Let's pivot to that then. AI as this transformation engine. Management's stance is notably, almost aggressively, positive, calling it one of the best things that's ever happened to the company. That's a strong claim.
It is a strong claim, and it kind of runs counter to the narrative you hear sometimes, right? The fear that AI will just automate everything away.
Yeah, for many companies, AI looks like a threat, operationally speaking.
But their argument is quite elegant, really. They're saying AI doesn't get rid of the need for coordination. It actually increases it. If AI tools start pumping out code 10 times faster or handling 5 times the support tickets,
The humans still need to manage all that output, track it, plan it.
exactly. You need better tools to track the work, prioritize it, manage the knowledge that's being generated, keep governance in place. The sheer volume and speed go up.
So their view is AI boosts productivity and complexity, which in turn expands the market for their kind of coordination and workflow software.
Precisely. They see themselves as the indispensable air traffic controller for a much busier digital workspace. Think about past shifts, open source, microservices, remote work. Each created complexity that their tools help solve. AI is just the next, maybe the biggest wave.
And they have numbers to back up this AI adoption, right? It's not just theoretical.
No, the usage stats are pretty impressive. They reported over 3.5 million monthly active users engaging with AI capabilities across their platform.
3.5 million. And how fast is that growing?
That's the really telling part. It's up over 50% just since the last quarter.
Wow, 50% quarter-over-quarter growth in AI users. That suggests people are actively choosing to use it.
It really does. And
Yeah.
significantly, this usage isn't just confined to, say, developers.
Ah, right. The sources mentioned it's widespread business teams and technical teams.
which supports that whole system of work idea. They want to own the workflow for the entire organization, not just the software development lifecycle. So you've got service teams using AI for ticket summaries, people in Confluence using it for drafting docs, marketing teams using AI in planning.
When AI becomes useful for everyone, the value of that central coordination hub just skyrockets.
Totally. And this has a direct financial tie-in. It's driving demand for their premium cloud offering, the Teamwork Collection.
Okay, so AI isn't just a feature, it's actually pulling customers towards specific products.
Management's quite clear on this. AI is a primary reason customers are migrating and upgrading. They want the cloud platform specifically to access these AI capabilities, and often that means moving up to higher value Teamwork Collection additions.
So AI acts as a catalyst for monetization.
Yes, and it's working. They launched the collection less than 2 quarters ago, and the results are already strong.
What kind of results?
A double-digit percentage increase in users adopting the collection. Also, crucially, driving upgrades to the higher tier editions. That means more revenue per user. And it's leading customers to consolidate, to drop other tools.
That consolidation point is interesting, getting rid of other niche tools.
Yeah, if a customer realizes, hey, the Atlassian collection with its AI features does what these 3 other tools did, but integrated, the platform becomes incredibly sticky.
It creates a kind of flywheel then. AI drives upgrades. Upgrades increase contract value and stickiness, which reinforces their position.
Exactly. It deepens the relationship. They're moving from being just a tool provider to more of a strategic partner, helping these big companies navigate the whole AI transformation.
Shifting the conversation from an IT purchase to more of a C-suite strategic decision.
Which fits perfectly with their long-term push into the enterprise market.
Okay, this feels like a good point to tackle what might be the trickiest part of the quarter's story. The cloud migration details and that apparent financial paradox.
Right, this definitely needs some unpacking. It's where the short-term accounting meets the long-term strategy.
Let's start with the big operational decision they finalized.
They formally set the end of life, the EOL date, for their data center products. It's now officially March 2029.
March 2029. Okay, so that's a firm deadline, about 5 years out. How did customers and partners take that news? Was there pushback?
According to management, the reaction was actually overwhelmingly positive. They stressed this has been telegraphed for years, so it wasn't a huge shock.
So it provides clarity.
Exactly. It gives those large organizations, the ones that need multi-year plans, a concrete date to work towards, removes ambiguity. Everyone knows cloud is the future, full stop.
And the reasons for pushing everyone to cloud must be compelling. Given the effort involved in migration, data center just can't keep up.
It really can't. All the innovation, 100% of it, is happening in the cloud. We talked about AI, but it's more fundamental too. Things like automation, advanced analytics, having isolated cloud environments for security.
Multi-cloud strategies.
Right. And critical compliance certifications. That's a big one.
I think the sources mention FedRAMP specifically.
Yes, achieving things like FedRAMP moderate status in their government cloud. For customers in sensitive sectors, government, finance, the cloud offers security, governance, and compliance that data center just can't match at scale anymore. It's fundamentally a more valuable and secure platform for them.
Okay, so the strategic direction is clear. Now, about the migration momentum in Q1 itself, you said it was strong.
Significantly stronger than they had expected, actually. The key metric they shared was that the number of data center seats that migrated and upgraded in Q1 doubled compared to the same quarter last year.
Doubled year over year. That's substantial acceleration.
It is. And they credit their partner network and internal programs, like something called Fast Shift, for helping make these complex migrations smoother for large customers. It seems like they're successfully lowering that barrier to entry for the big migrations.
Which brings us to the financial puzzle. Migrations doubled, RPO soared, yet they slightly lowered the full-year organic revenue growth outlook. By 0.5 percentage point, I think.
That's right, 0.5 percentage points. And yeah, on the surface, it sounds contradictory, doesn't it? Winning strategically, but the headline number dips slightly.
It definitely caused some confusion. How do we reconcile that?
It boils down almost entirely to revenue recognition timing. It's a short-term accounting headwind that's actually caused by long-term strategic success. We really need to unpack this clearly.
Okay, walk us through it. Maybe an analogy helps.
Sure. Think about cloud revenue. It's recognized ratably smoothly over the subscription period, like paying for Netflix, right? You pay $15 a month, they recognize $15 each month. Steady income stream.
Got it. Ratable, spread out.
Now, data center revenue was historically a mix. Some parts were ratable, like maintenance over a year, But other parts, particularly older license models or even some maintenance renewals, could have a significant chunk recognized up front, right when the deal was signed.
Ah, okay. So if a customer was planning to stay on data center for another year, maybe renew a big license up front, but instead they migrate to cloud now.
Exactly. You lose that immediate large chunk of revenue you would have recognized this year from the data center deal. Instead, the entire value of that customer's contract shifts to the cloud's slower, steady, ratable recognition schedule.
So your bookings, the total contract value signed, go up, which is great long term, but the revenue reported in this specific fiscal year takes a temporary hit because that upfront data center cash disappears from the books for this period.
You nailed it. They're essentially trading a bit of recognized revenue today for a much better, stickier, more predictable, recurring revenue stream tomorrow. It's optimizing for lifetime value, not the immediate quarterly report.
So the slight dip in the outlook is actually a result of doing better on the strategic migration front. It's a cost of success, in a way.
That's precisely how management frames it. And there's a smaller secondary factor to the marketplace.
How does that play in?
When customers move from data center apps to cloud apps, Atlassian's take rate, the percentage they keep from partner app sales, is slightly lower on cloud compared to data center. So as more usage shifts, that mix change also puts a tiny bit of pressure on the overall organic growth number.
Okay, two factors, both driven by the successful cloud shift. So despite this outlook tweak, management's confidence isn't shaken.
Not at all. They were very clear. They see faster migrations as a really good thing. It leads to better bookings, stronger CRPO, that's the contracted RPO expected in the near term, and it reinforces their path towards that long-term 20% compound annual growth rate target they set back in FY24. They're confident they'll hit that.
Makes sense. Now, this Q1 surge in migrations was strong, doubled year on year. Should we expect that pace to just continue linearly until the 2029 deadline?
Management specifically cautioned against that. They said expect variability quarter to quarter. While this Q1 momentum is great, their core expectation hasn't changed. They still believe the bulk of migrations, the major wave, will happen closer to the EOL date. Think 2028, 2029.
So these current migrators are more like the proactive early adopters.
Seems like it. The ones really keen to get the AI, security, and compliance benefits of the cloud right now. The big rush is likely still a few years out.
Okay, that sets a realistic timeline. It's definitely a marathon, even if they had a fast start this quarter. Let's circle back to AI then, because they shared some really fascinating data points here, stuff that gets right to the heart of how AI impacts actual work.
Yeah, this part really underpins their whole thesis. The CEO was emphatic. They believe the number of developers worldwide and the sheer volume of technology being created is going to expand significantly in the next 5 years, not shrink.
Which is interesting because the common fear is AI replacing developers, right?
Yeah.
Why are they so confident in expansion?
Their perspective comes from seeing what actually happens inside hundreds of thousands of organizations. They argue AI automates tasks, like writing boilerplate code, but it doesn't automate coordination. If coding gets 50% easier.
That companies will just try to build 50% more stuff, tackle more projects, chase more opportunities.
Exactly. That increased ambition, that higher velocity, creates more need for coordination, planning, tracking, all the things their platform does.
And they did a study that seems to prove this out with real user data, the one looking at third-party AI coding tools.
Yes, that was a really smart piece of analysis. They specifically looked at cohorts of their customers using tools like GitHub Copilot, Claude Code, Cursor, deliberately not including their own RoboDev to avoid biasing the results. They wanted to see the raw impact.
Okay, so isolating the effect of these external AI coding assistants, what did they find in that group?
The findings are pretty compelling. This cohort, the ones using the AI coding tools, they expanded their paid seats on Jira 5% faster than customers who weren't using those tools.
5% faster seat growth. Okay.
And maybe even more significantly, these AI-assisted teams were managing more than 20% more projects within their organizations.
Wait, say that again? 20% more products being managed.
That's right, more than 20% more.
So far from reducing the need for management or seats, AI usage seems to correlate with more seats needed and significantly more work being juggled. It directly contradicts the replacement narrative.
It absolutely does. It shows AI acting as a productivity and scope multiplier. Developers get more done faster, so they take on more initiatives simultaneously. But guess what? Integrating all those extra projects, managing dependencies, communicating progress, That complexity falls squarely onto the workflow platform, onto Jira.
So Jira's role as the central coordination point becomes even more critical, not less.
That's the core argument. The CEO basically said, look, these AI agents, whether they're writing code or doing something non-technical from Canva or Box, they perform their task, but then that work has to funnel back into the Jira workflow for tracking, review, approval by humans.
The AI might play the instruments, but the human using Jira is still conducting the orchestra.
A good way to put it. And conducting that orchestra requires immense context. That's where their teamwork graph comes in.
Right, the graph connecting all the work, people, code, docs.
Yeah, they mentioned it's now over 100 billion objects and connections and growing incredibly fast. That massive data set is what makes their own AI tools, like Rovo, so contextually aware and valuable within an enterprise.
Speaking of RovoDev, their own AI tool, it's generally available now, and they shared an interesting internal use case.
They did. It shows it's not just hype. It has practical high-value applications. Apparently, over half of Atlassian's own internal security incident findings are now being identified by RovoDev.
Over half, so it's effectively acting like an automated security analyst for them.
Pretty much. Finding vulnerabilities based on its understanding of their code base and infrastructure, which frees up their human security engineers for more complex work. This is a great proof point.
Okay, so AI is driving usage, complexity, and even internal efficiency. The big question then is monetization. How are they capturing the value?
They're taking a multifaceted approach, which makes sense, not a one-size-fits-all model.
What are the main mechanisms?
One major one is consumption-based pricing. Think Rovo itself and AI credits. You pay for what you use. That aligns well with AI, where usage can fluctuate a lot.
So pays-you-go for the AI compute, essentially.
Right. Then you still have subscription models, especially for higher value bundles like the service collection agents and assets, and platform capabilities like Bitbucket pipelines or their Forge developer platform also often have usage-based components. It's a blend.
Subscription for the base platform, consumption for the intensive AI compute parts.
Generally, yeah. And we absolutely have to mention Loom here.
Ah, yes, the video messaging company they acquired 2 years ago. How's that playing out as an AI monetization example?
It's been a huge success story, apparently. The specific AI SKU within Loom, focused on things like AI summaries, enhanced video creation is growing over 100% year over year.
Wow, 100% growth.
And it's not small potatoes. Loom is now a standalone business doing north of $100 million in annual recurring revenue. It shows they can acquire, integrate, and successfully monetize these AI-native work tools.
That's a strong proof point for their M&A capability, which leads us nicely into their recent acquisitions.
Exactly. The Loom success really validates their overall M&A philosophy.
Which they described as pretty pragmatic, right? Not just buying anything flashy.
Yeah, they emphasize looking for strategic fit, great teams, having the capital, and crucially, the right timing. It's discipline.
And that philosophy seems to underpin the two recent acquisitions, the browser company and DX. These feel quite strategic.
Very strategic. They really signal where Atlassian sees the future of knowledge work heading.
Let's start with the browser company. That one feels like a bigger leap. Acquiring a browser company. Why?
It's definitely bold. The thinking here seems to be about owning, or at least significantly shaping, the primary interface layer for work. Their argument is that today's browsers, Chrome, Edge, Safari, were designed before the sauce explosion and definitely before AI agents became a thing. They just aren't optimized for how people juggle work now.
So the goal isn't to compete with Chrome on the consumer side, but to build a better work browser for the enterprise.
Precisely. Imagine a browser interface where your sauce apps, specific AI skills, maybe even automated agents, are deeply integrated. And critically, it's all contextualized by the teamwork graph data from Jira and Confluence.
So bringing the context and governance into the browser experience itself.
That's the potential game changer. If they can provide a secure, governed interface that understands your work context, connects to your projects, and interacts seamlessly with AI, that could be incredibly valuable for enterprises struggling with app sprawl and information chaos.
Okay, I can see the strategic logic there. Now, what about DX? That one seems more focused on developer productivity measurement.
DX fits perfectly with that AI acceleration story we discussed earlier. Remember the 5% faster seat growth, 20% more projects?
Right.
Well, as companies lean into becoming software businesses and they invest heavily in engineering teams and these new AI coding tools, the executives need to know, are we getting our money's worth?
So DX provides the metrics to prove the ROI.
Exactly. It helps organizations measure developer productivity, find bottlenecks, and actually quantify the impact of tools like Copilot or RoboDev. It answers that critical question about the return on investment for the growing engineering spend. It helps shift Atlassian from just supporting work to optimizing and measuring it.
Got it. So these acquisitions are about the interface layer and the measurement layer around this accelerated AI-driven work. How does this tie into their go-to-market strategy? Brian Duffy has been CRO for about 9 months now.
Management described the GTM strategy as evolutionary. It's building on their decade-long push into the enterprise. The focus now is on becoming an even better strategic partner for their largest customers. More high-touch, more value-driven selling, less transactional.
And the opportunity within their existing base is still massive, right?
It's kind of staggering. They estimate a $14 billion serviceable addressable market just by selling more into their current customer base. That includes the huge data center to cloud migration opportunity, plus cross-selling and upselling the various collections. Huge runway right there.
And are they landing those bigger deals? The sources mentioned some significant wins this quarter.
They did. Some of the largest deals in the company's history, apparently, across pretty much every sector: tech, finance, telco, and geographies. The common thread: big strategic moves to the cloud, consolidating other tools onto Atlassian, and real excitement about the AI capabilities. These are major long-term commitments.
And the partner network is key to handling these large, complex enterprise deals and migrations?
Absolutely critical. The channel touches about half their revenue. They view the partner network as mature, well-equipped, and ready to handle these large migrations, especially with programs like Ascend helping them scale up. The partners are essential for executing this enterprise strategy at speed.
Especially if migrations are indeed accelerating like they did in Q1, you need that partner bandwidth.
For sure.
Okay, as we wrap up, let's just nail down the specifics on that cloud guidance increase again. It relates directly back to that revenue recognition discussion.
Right, good to be precise here. They raised the full-year cloud revenue growth outlook by 1.5 percentage points. So the new guidance is for 22.5% year-over-year growth.
And the absolutely key point is why they raised it by that 1.5 points.
Yes, they're very explicit. That increase is only because migrations from data center were stronger than expected in Q1, and they carried that beat forward. It's purely reflecting that accelerated migration momentum.
So they didn't increase their assumptions for other organic growth drivers, like new customers or expansion within existing ones.
Correct. They kept their underlying assumptions for things like new logo growth and expansion rates conservative and unchanged. Even though they confirmed the net expansion rate is still very healthy, 120%, meaning customers spend 20% more year over year on average.
They didn't bake any extra optimism from that into the guidance raise.
Exactly. They wanted the market to clearly understand the lift was entirely due to the migration and acceleration beating their prior forecasts. It's a cautious approach to guidance.
It shows a certain maturity in communication, maybe? Underpromise on the organic side, while highlighting the strategic migration success.
Seems that way. Set realistic baseline expectations, then deliver the upside based on executing the core strategic transition faster than planned.
And finally, we should just acknowledge the executive change announced. CFO Joe Binz is departing.
Yes, that was confirmed. The reason given was personal wanting to be present for significant life events. He also framed it positively, suggesting new energy and ideas are good for a company moving this fast. The focus now is just on a smooth handover.
Okay, so pulling it all together, despite that nuance around revenue recognition timing, the overall message from management remains incredibly bullish on the long term.
Overwhelmingly positive, yes. They see the short-term financial noise as just that noise. It's overshadowed by the clear success they're having executing on those three big transformations: embedding AI, deepening enterprise relationships, and accelerating the cloud shift. They seem very confident about hitting those long-term targets.
So the main takeaway for you, the listener, seems clear. Don't get too caught up in the slight near-term revenue guidance adjustment. View it as the mechanical outcome of successfully pulling forward their strategic goals.
Right. They're moving faster towards that cloud-only AI-powered future. That's driving record future commitments, seen in the RPO, and cementing their role.
They're trading a little bit of recognized revenue now for much more long-term committed value.
Precisely.
Which brings us to our final thought for you to chew on. That data point about AI coding tool users expanding Jira seats 5% faster and managing 20% more projects. That feels fundamental. It suggests AI doesn't reduce organizational workload, it just makes the execution part faster, which in turn swamps the coordination layer with way more volume and complexity.
The bottleneck shifts.
So the provocative question is, if AI keeps accelerating the output of every knowledge worker, does the resulting coordination chaos become Atlassian's biggest, most unassailable moat? Are they positioning themselves as the essential system to manage a world that's about to get exponentially busier and more complex?
It's that paradox, isn't it? AI simplifies task execution but amplifies management complexity. And that management complexity seems to be exactly where Atlassian lives and thrives.
Thank you so much for tuning into the quarterly call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.